Hey guys, Chris from Spectrum Education. Wanted to see if I could answer the question for you today. Why should you invest your time to learn about options trading? So what I'm going to do first is talk about the objections. The first objection for a lot of people is options are way too risky. And I've heard this several times recently, having conversations with people about option trading. Uh, Options can be risky. That's absolutely true. But the reason education is so important is to learn how to control that risk. That's exactly the purpose of my program that I'm putting together, is to teach people the basics about options and how the risks work and what you need to be able to do to control that risk and make it manageable. The next thing that people say is that options are too complicated. There are definitely some very complicated strategies that you can get involved in. Learning the basic strategies of options, such as purchasing options, option spreads, selling options for income, it's not that complicated. And once you understand the basics, it's fairly easy to grasp. The next objection many people have is they really just don't have enough time. They don't want to become day traders. They've got other stuff to do. They've got jobs. They've got hobbies. They don't want to sit in front of their computer all day long. Once you learn how to manage your risk and manage your positions, you can really get by on less than 15 minutes a day. Sometimes if you're trading in a certain time frame, you could only look at your positions weekly. It all depends on the type of trading that you are doing. So the next question to ask is it worth it? Should I spend my time learning to trade options? How would it change my life? Will my life be better if I learn to trade options? There are basically two categories of option traders or option investors. One category is for speculating, and the second category is for income. Usually those two categories are on opposite sides of a trade. Option speculators are always looking to hit home runs, and with a small amount of invested capital, you can make a very large, significant return. That's by using the power of leverage in purchasing options. Now, options are different than stocks in several ways, but the biggest way is an option is just a contract between a buyer and a seller, and options always have a time limit, always. So you can buy options that have over a year before they expire, and those options behave very differently than an option contract that expires in a week or sometimes even less than a week, 2 or 3 days. Learning the difference and how that time plays in is a big part of what you need to learn to be able to control risk. The advantage as an option seller is that time works against the option buyer because it's always decreasing the value of the option, but the option seller actually sells the option for a certain price, and then they want the price of the option to go down because it either expires worthless or the option seller can always buy the option back for less than what they sold it for, and the difference is their profit. Let's say that you find a stock that you really like and you decide to make a purchase. Let's say the stock is $200 a share and you decide you want to buy 300 shares, so that's going to cost you $60,000 to buy that stock. Let's say that you place the trade, you pay the $60,000, earnings come out, everything, the news is favorable, and the stock indeed does go up. Let's say it goes up by 10%. So it goes up to $220 a share. Well, now your position is worth $66,000. You've invested $60,000. You've made a nice 10% profit of $6,000. So your position is now worth $66,000. Basically, you made a 10% return on the capital that you invested. The problem with that trade is it tied up a lot of capital. That capital, $60,000, is a big chunk of your investable asset in your account. So let's look at how that would play out if you used options. So the same stock with the $200 price, you could purchase an option contract, and let's say that option contract only costs you $5 a share. Okay, you decide to buy 6 option contracts, and So that's 600 shares that you would have control of, $5 a share. So that's a total investment of $3,000. Well, that's a lot different than 60. Much less capital used to place that trade. Well, if the stock went up 10%, it went to 220. There are a lot of different parameters, and this is just an example, but let's say that your option is now worth $15 per share. Now your option position is worth $9,000. Well, you invested $3, and now it's worth $9, so you've made the $6,000, the same as you made with the stock purchase, but you used $3,000 of capital to put that position on versus $60,000 of stock. That's just an example of the leverage that you can obtain by buying options instead of buying stock. One of the biggest advantages of options is many people like to trade and speculate in the stock market, and they're always looking for $15, $20, $25 stocks because those are the ones they have the capital to purchase. Well, what if you could speculate on Apple or Google, or well, Apple is not so expensive anymore because it's split several times, but Tesla, Alphabet, stocks that cost $1,000 a share, most people can't even touch them because they cost too much. And, most people don't like to buy 2 shares or 3 shares. They like to buy round lots of 50 or 100 shares. So options allow you to tailor how you want to speculate on a certain position and use much less capital. The other advantage to options is it's very easy to make speculative trades when the stock is going to go down. It's very hard to do that with stock. You have to short sell. You have to have a margin account. And if you've been watching the news, short selling can get you in trouble very quickly, and always has been able to. That's why short selling is usually left for the pros. But it's very easy to use put options and to hedge your portfolio or to actually speculate when a market or a particular stock gets a little too pricey. You can bet on it coming down. So options are great for speculation. Now let's talk about the flip side of the coin, and that's for income. Whenever somebody wants to use options for speculation, they always are going to impart some leverage. That leverage has time working against it. Well, someone has to sell them that position. Well, you can be an option seller. You don't have to own anything to sell it to them. You can just say, I sell you this contract. So basically, you're only taking the other side of the option buyer. Well, as the option seller, you receive income. Now, you're taking on some risk, and you have to learn to manage that risk, but you receive income, and you can sort of think of it like if you have a nice portfolio of stocks, you can actually set up consistent income where you sell options monthly and generate very easily on the range of on the aggressive side, you could go up to 5% a month in income. Now, you're not always going to win. Sometimes the stocks are going to sort of do things that you don't expect, and you have to work in your risk management plan where when that happens, you know exactly how much you can lose and it goes against you. But that's the same as investing. You buy mutual funds, and there's always periods of time when you get a slight hiccup, and then you go right back to collecting your dividends and your mutual funds appreciating. So over the long term, selling options is a fantastic income strategy. Just have to learn the basic principles about how to manage the risk and how to set up the trades. An example I like to use for option selling is, think about if you went to a golf tournament and the golf tournament offers a hole-in-one prize of a car. So let's say you're the person that's supplying that car. Well, if you had a $20,000 car and you charge the golf tournament $1,000 to have the giveaway, so if anybody hits a hole-in-one, they win the car. So if that were to happen, you would lose your $20,000 car. You'd have to give it to somebody. But if that doesn't happen, you keep the $1,000. Well, is that a good deal or not? Well, there are lots of parameters that you have to take into account. If If the hole is 200 plus yards and it's a very difficult, challenging hole, chances are nobody's going to make a hole in one. If it's a very, very easy short hole, the probability goes up that somebody could make a hole in one. If it's a bunch of duffers, the average handicap for the tournament is pretty high. The chances are a lot lower. If it's a PGA Tour event, then the chances are a lot higher. So obviously there's lots of different parameters, but if you got that scenario of making 1,000, risking 20,000, and you did it every day for 2 years, you could end up making some pretty good income, even if every now and then a hole in one was made. So and there's lots of ways to manage that risk in the option market, but that's just kind of a basic general example of sort of how an income strategy is set up. You set up a very, very high probability win for a small amount, and you do that over and over and over. Hopefully this has kind of opened your eyes and sort of made you think a little bit about what is possible. My option training course is coming up. I'm finalizing that in the near future, and we're going to be offering a very good training program to teach how to use options and how to implement it into your portfolio and make you a much better investor. Thanks for watching my video. If you would, leave me a comment and let me know any questions you have, and we'll definitely try to address those in future videos or in upcoming classes. Thanks. Have a great day.